Okay, I want to welcome you to the September 11th Natural Resource and Entertainment Symposium. This initially was going to be at the Princeton Club live, and unfortunately, thanks to Mayor de Blasio, we're doing this as a virtual conference. But I hope you will enjoy it, plus you'll be able to review it in detail later. I have a guest of Marc Chandler, Edward Sugar, and myself will be speaking. And we have 3 company presentations. We'll be archiving this on the YouTube, so you don't need to take any notes. Okay. Basically, we have a number of events coming up for those of you who live in the New York City area. We have October 6th, which will be another webinar like this. October 13th, we have a live event at the Princeton Club, and we think we'll be able to do that on the 13th. And then in November, we'll also have a webinar as well as a live event on the 17th. So there are a number of events that we'll be able to go to, both virtually and as well as online. We've also started, just for the month of September, a series of webinars where I'm going to give out my newsletter for those of you that register in advance. We put it up on our website so you can link it up. You can see our newsletter, and then we're going to discuss what the market will do briefly on Wednesday, and then we have a special company presenting. Thereafter, it's archived, so the Victoria Gold event was already archived. You can see it on YouTube. And then we have events with 3 very good gold companies, because obviously we're very bullish on gold. Normally we do these events in New York and Hong Kong for 4 reasons. The first and most important is to give you companies that are investable, that have a good risk-reward profile. And I think we have that today and almost all the time. Doesn't mean every single company is going to make you money, but overall as a batch they do. And certainly better than the benchmarks, which is what we use. The second is we offer you some informative talks, and clearly the talk you're going to hear by Marc is going to be excellent. He's presented us before, a very knowledgeable person, and we're always delighted to have him. Unfortunately, while we normally give you good food and beverage, and we're sitting here relaxing, we can't quite do that now because of the fact that this is virtual. However, with 3D printing, perhaps in 20 years we'll be able to send you the food as well. And then the fourth, of course, is valuable networking opportunities, which unfortunately we can't do virtually, but we do live, and we certainly will welcome you to be here. The issue of 2020, unlike 2018 and 19, is uncertainty. Markets are changing, they play ping pong, and certainly for the next 60 days with the election, things are going to be rock and roll. No question about that. People always like to say markets are different, but you know something? They really are different, and there are 3 reasons. The idea that we have real negative bond yields and even have negative oil pricing, which was certainly an amazing thing to watch. The fact that we have the corona pandemic, which is being dealt with very differently than anything we've seen in the last century. We can discuss that, but it's certainly very different. But most important is computer domination. It's up to 90% in volatile markets. This means trading times are very reduced, 4 to 8 times at least. We saw how Apple and Tesla went 10 and 20% down in 2-3 days, not in 2-3 weeks or 2-3 months as it used to be. So these time frames are constantly being changed, which is why we are constantly changing our targets. So again, this is a very different time frame than what we're used to. But what's not different, and this is the most important thing, with all this uncertainty, this is an opportunity. So yes, it's a very dangerous time, crises being, as we know, danger and opportunity, but there's plenty of opportunities to make money, and certainly plenty of opportunities to be very cautious about things. This is the important part. Between now and the next 2 months, and the November election, and somewhat thereafter, markets are going to be rock and roll, and perhaps thereafter. But regardless of who wins, whether markets rally or drop, both entertainment and gold will outperform. That's very important because the sector that a company belongs to is critical. And hence, we're presenting you with 3 opportunities, which I'll be introducing after Marc speaks. Because you want to concentrate, because it doesn't matter. You know, we can talk about marijuana doing better if Biden wins. We can talk about oil doing better if Trump wins. But regardless of who wins, entertainment and gold will do well. That's my main point. So I'm going to introduce each of the companies after Marc's talk. Then we have a guest analyst and myself will be asking some questions, and if there's time, we'll have audience participation. The thing to note is the companies will not get copies of your contact information. So if you do want to contact them, and I hope you do, please go to their website and sign up for their email list. So in a moment, we're going to exit here. We're going to bring up our first speaker, which will be Marc. Okay, give me a moment because we're not always the best. A second on this. First, we bring up Marc. Hello, Marc. Nice to have you. And
good morning.
We're going to make Marc the presenter in a moment. Switch. And now, for the next few minutes, you're going to hear an excellent talk on the U.S. dollar. And obviously, the U.S. dollar's direction is very important for markets, not just for gold, but for all markets.
There you go, I think, huh?
Okay, we get...
Can you see that?
I can see that. I don't see you at the moment, though.
Huh, you don't see me. Yeah, I think that's because the slideshow is taking it up.
Okay, well, usually they're both, but...
Let me see if I...
Did you press your video, Marc?
I think so. Let me just make sure. I think so. Why don't I just begin, though? It looks like it should come up. Yes, can you see me? Okay, good. So now if I can just get over to this PowerPoint. So here's what I'd like to do. Thank you very much for your time this morning. What I'd like to do is really, my specialty is foreign exchange, and I will try to stick to that as much as I can. And so the first thing I want to suggest to you is the way to think about the dollar is the way to think about the way the Federal Reserve thinks about it. And that's why I brought you this chart called the real broad trade-weighted dollar. It should be real, which means it's adjusted for inflation, broad because it includes all of our trading partners, and it's trade-weighted. And so you can see that there's been this chart goes back to the early 1970s. And you can see that there's been 3 big dollar rallies. The first one is the Reagan dollar rally. That was the policy mix, the expanding fiscal policy, spending money as well as the tax cuts. And then that was Paul Volcker stepping on the brake. And that policy mix, tight monetary, loose fiscal, is really a key to currency movement. And I look for countries that have that. Tight monetary, loose fiscal policy, and that tends to be an appreciating currency. That big dollar rally I don't know what that was.
I think you've unmuted everyone. If you mute everyone, I think you might get that problem back away.
That was me because some people were complaining they couldn't hear you, Mark. Mark, are you speaking now? Because now I can't hear you. One moment, folks. I'm getting bad with this thing.
Okay.
Henry, if you mute and mute.
Some of you may be muted. Oh boy. One moment.
There you go. Can you hear me now?
Now we hear you.
Okay. Now I can't hear you though, but okay. So what I was trying to do is describe for you this chart of the trade-weighted dollar. And to cut to the chase, after the Reagan dollar rally, we had the Bill Clinton dollar rally, and now we are someplace in the Obama-Trump dollar rally. And in my view, this third big dollar rally since the end of Bretton Woods is over. I thought it was over about a year ago, but to Henry's point, the COVID crisis marked a new disruption, and you can see what happened at the very end of this chart. You can see another spike up, and that's what the dollar did in March when the COVID first hit and the markets became unsettled, including, of course, the U.S. Treasury market. So the dollar, in my view, that we should be anticipating, just like these other dollar rallies lasted many years and the declines lasted many years, if I am right about this, the dollar bear market has barely begun. And by that I mean, keep in mind what happened when at the peak of the, at the low point of the past cycle. Where did we get to? The euro, which had gotten above 120 on the 1st of September before some ECB officials objected to it, had gotten up to 160 in the summer of 08. Sterling was above 210. And both the Australian dollar and the Canadian dollar traded above 1 to the US dollar. I'm not saying that we're going to go back to those levels today or tomorrow. But within these cycles, and that's one of the things I like about the foreign exchange market, these trends can last a long time, 5 to 10 years. And so if I'm right about this, it means it has several implications. But I just want to take you through another chart first before we talk about those implications. And this is one of the things, to Henry's point, of how the world changed. This chart shows you the amount of negative yielding bonds in the world. And I did this chart a couple of days ago, but you can see it's almost $15 trillion of negative yielding bonds. And that had made the U.S. Treasury market more attractive. But what has happened is European bonds have not fallen that much, and U.S. bond yields have. And so the two legs that the dollar rally stood on, growth differentials and interest rate differentials.
Hot weekend here, so taking advantage of that.
Excuse me, if someone could turn their phone on mute.
Yeah, they should all be muted.
So in any event, you've got this, I just wanted to point out that the growth differentials and interest rate differentials are two legs that the dollar stood on, and both of those legs have been sharply reduced. And I know many people are concerned that when you have high debt levels, and this is of course all the major countries and many emerging markets have issued a lot of debt as the economies have stalled, as they deal with COVID. And so what is that relationship between bond levels, bond yields, and interest rates? Bond levels and debt levels. And I thought this chart from J.P. Morgan sort of captures it. The blue line shows you how world debt has increased as a percentage of world GDP. You can see that 280% debt to GDP. And what has happened to the average yield? it has fallen. So you don't want to think about more debt equals higher interest rates. Even though that is what we're taught in school, that's what intuitively it makes sense. Countries and companies issue more bonds and yields will have to go up, supply and demand. But that is not, in fact, what has happened. And you can see this chart, it's not just for 1 year or 2 years, but you can see how far back. This chart goes back to 2000. And so you can see there's not a very good relationship between debt levels and interest rates. And the other point here I'd want to make for you is about policy rates. This is the policy rate that the central bank set. And then all I did here, actually it wasn't even me, I got this chart from Van Eck, the asset manager. And what they did was they adjusted the overnight policy rate with the 12-month expected inflation. And what this shows you is that most countries on this chart are at negative real interest rates. That is, the policy rates are negative. And that is supposed to help stimulate the economies. Now I'll show you what what I think the concerns are going forward. First, we still haven't dealt with the virus satisfactorily enough, and I think what this means is that we're still in for a tough winter, a tough fall and a tough winter as people adjust to going back inside in the northern hemisphere, and still no vaccine, even though one is possible. I saw a survey that had about 30% of Americans would not take the virus, take the vaccine for the virus, and that's partly the anti-vaxxers, but it's also concerns that governments, not just the U.S., but many countries are speeding the process to get a vaccine, and they're cutting corners. The big issue for me going forward, regardless of who gets elected in the U.S. in November, is economic nationalism. You see this with medical supplies in a very pronounced way. I'll give you an example. Before COVID, the U.S. was importing about 95% of the penicillin from China. This is unacceptable. And I think that we see other countries besides the U.S. not only want to be food self-sufficient, energy self-sufficient, but increasingly medical devices and medicines self-sufficient. I think we're in for a period of economic nationalism, and that means bringing back, government's policies to encourage companies to pull back and relocate closer to home, if not in home itself. And again, the U.S. is not the only one playing this game. Japan and India, for example, are offering financial assistance to companies that relocate from China. Economic nationalism presents opportunities, and I'll go through those in a minute. I think the disparity of wealth and income is a very important issue. It's finally being taken up by the Federal Reserve, but I think we're going to see this to be a continuing both a constraint on policy and a source of new efforts. The disparity of wealth and income, very serious with political ramifications. And the fourth big challenge I see is that I think I'm in the camp that suggests the U.S. and China have entered into a Cold War. And this means decoupling to some extent. It means finding things that we get from China, doing it ourselves. And the same thing for China. For example, they are at the mercy of a duopoly on mobile operating systems, OIS and Android. It makes no sense for China not to develop their own mobile operating system. Similarly, the key to modern technology is semiconductor chips. China has to up their game, and that means that what we're really calling this is import substitution. They are importing semiconductor chips. They need to make their own, and you'll see how the U.S. is being go after some of those Chinese companies that fabricate semiconductor chips who are using U.S. technology. I think the Cold War is so important that it's not only impacting the U.S.-China relationship, but look what happened. It looks like Russia has poisoned one of its critics on Russian soil. And what this means is that it could jeopardize the Nord Stream 2 pipeline that brings natural gas directly to Germany, bypassing the Ukraine. Now, I think that just like think about what happened with Nixon and Kissinger opening up China, it was done not because we thought China was going to become more like us. It was done as an offset to try to squeeze the Soviet Union. I suspect that the same thing is going on in the U.S. State Department today, not thinking so much about incorporating China, but really how could we use Russia? How could we play the Russia card to help limit Chinese options? And I think that Russian card is harder to play, not only after Crimea, but now after the poisoning of one of their critics. Lastly, just to talk about some of those opportunities. So if I write about a weaker dollar and the rise of economic nationalism, it tells me that there'll be an opportunity in U.S. manufacturing. So I look at, so there's different ways to think about U.S. manufacturing. And so, of course, you could look at the largest manufacturers. I would also be looking at industries that are more likely to onshore or to come back onto the shore or close by. And that would include parts of autos. It would include battery technology. I would encourage you to think broadly about manufacturing and to appreciate that the dollar was a headwind to many manufacturers trying to export from the U.S. for the last decade. The combination of economic nationalism and a weaker dollar will make manufacturing more attractive here in the U.S. Second opportunity, I think, is that of non-U.S. investment. A weaker dollar is going to boost the returns of overseas assets, overseas investments, when we convert them back into our U.S. dollar. So I think about non-U.S. investments, and here I think what's interesting is the Bank of America Merrill Lynch poll found that over a third of asset managers wanted to be overweight European stocks and the euro for the first time in several years. Many U.S. global funds are buying Japanese T-bills even though they have a negative yield, because what they've done is they've taken the dollars, swapped them into yen, and on that exchange, on that financial engineering of swapping the dollars for the yen, that makes the T-bills in Japan, which have a negative yield of about 5 or 7 basis points, turn into a positive return for U.S. institutional investors. And lastly, I find myself agreeing with Henry about gold. I'm not a big fan of gold traditionally. I always think that there's other sources to get the other investments to get the same kind of return and the same kind of protection in portfolios. But I think that a couple things have changed. One is low interest rates in the U.S., so bonds are no longer the protection or the hedge for equities. I think that the negative interest rates and low interest rates makes gold a more attractive investment because of the opportunity cost. Guys like me would say that because gold didn't have a carry, didn't have a yield, that it was a wasting asset. But now that interest rates, say in Germany, are negative out 30 years, the UK today had a 6-month bill auction for the first time negative yields. So I think the combination of uncertainty and globally, geopolitical uncertainty, negative interest rates, and a weaker dollar all support gold prices. When I turned bullish gold at 1,400, I thought that there was potential to 2,000. That was how I thought one could make 20%. And now I think that that 2,000 is, we shot through that, but we're really still gravitating around. It's sort of like what happened with the euro. We got up to 120, but we're still really in a 117, 119 trading range, and we just need to be careful as we flirt or fray the edges. I'm thinking now gold can go up another 10 to 15%. That would take us, in my mind, to 2,200 to 2,300. And so just to wrap this up for you, try to keep you on schedule here today, I have been a dollar bull since my first book came out in 2009 called Making Sense of the Dollar. I anticipated, this is shortly after Lehman's failure, I anticipated a long-term dollar rally. I now think that long-term dollar rally is over. And that dollar strength had been a headwind for U.S. manufacturers. And I think that with economic nationalism makes opportunities here for U.S. manufacturers and to invest, to appreciate that if we are in a weaker dollar environment, a return on foreign assets that is non-dollar assets, look more attractive. And I still think that there's opportunities here in gold for about 10 to 15%. So with that, let me just conclude, and I think we have some time for some questions.
Unfortunately, we don't. We've actually gone to the time we need, so which is good. But I would like to make one point about the Cold War with China. In 1947, there was a Saturn-Pluto conjunction, which was the start of the Cold War with Russia, more or less. And this year, we have the same Saturn-Pluto conjunction, and it looks like the start of a Cold War with China. Very similar astrological configuration, which some people have talked about very privately for years.
Thank you very much.
Thank you very much. Okay, folks, give me a moment. Well, actually, if you move it, he can talk. Wait, can people hear him?
That's fine.
Okay.
Go ahead, Jack.
All right.
So thank you, everyone, and thanks, Henry. We've had great success, at this conference, and we truly think that the theses that you're proposing, we certainly agree with them. We've not been dollar bulls, and in any long-term context, and we do believe we're at the beginning of a pretty wicked bear market.
A little louder, please, or put it. You can either talk louder or put it a little louder on your screen, please.
All right, is that better?
Yes, perfect.
Sorry. So we spent the last decade consolidating, the historic Comstock Lode District in northern Nevada. We have over 10 square miles of properties within the borders of our district, and as most people may know, the Comstock Lode produced almost 200 million ounces of silver and over 8 million ounces of gold in the top 2.5 mile strike. And what we did certainly consolidated the whole district. It's about 10 square miles. And our biggest claim to fame is we entitled it. We worked not only in cleaning up all the zoning, but we worked in 2 counties, putting in new ordinances, changing master plans, and really garnering the social license to to be allowed to return mining to this, really world-class district. The grades, both gold and silver, were astronomical. No pun intended there. It's just been a really, really incredible ride. And what we've done now is we sort of partnered in a very strong way with Tonogold, and Tonogold, I believe, will be presenting following me with some incredibly exciting revelations, for lack of a better word. We sold the Lucerne mine to Tonogold, so Tonogold will now own 100% of the circle that you see right in the middle of this picture. The Lucerne mine has a great resource. It's a near-surface oxide-based open pit. Tono has calculated the resource and identified some significant opportunities to expand it to the east. And in that agreement to sell it to them, we've also given them the option to lease a fully infrastructured production platform that is the circle just to the left. So it's a fully integrated, fully permitted operating gold and silver mining operation. We test mined from 2012 to 2016, and so there's a tremendous amount of data. While Tono was evaluating the Lucerne mine, they identified some of the geological structures to the east, which I just mentioned. They secured some additional deposits, and then that led to us leasing them 2 entirely different trends. From that point, east of Lucerne straight up is the Occidental Lode, and the Occidental Lode is parallel to what's just to the left of it, the historic Comstock Lode. So Tonogold now has control and lease of the 2-mile strike known as the Comstock Lode and an almost parallel Occidental Lode right next to it. And they just announced that they're commencing drilling, and I'm not going to steal any of Marc's thunder, but it's remarkably exciting. To the south, we still control about 3 miles of trend, which we call the Dayton Spring Valley Complex, and we're going to talk a little bit about our exploration, geophysics, and development that will be ongoing there as well. The last thing I'll say before we go to the next slide is that production platform that Tono can lease is also a perfect location for us to innovate and commercialize mining technology. And you'll hear about one that we just had breakthrough on and we're commercializing in Mercury remediation. Go ahead, Zach. So, you know, the company has realigned itself with great focus. Sort of the four little appendages that you'll be seeing at the left of the Comstock Mining green circle, those are assets that we're selling. We're selling all of our non-mining assets for total value of over $25 million. And then we have realigned our northern properties, our processing system, and our southern properties into wholly owned subsidiaries. Tono's working to the north, we're working to the south, the processing facilities in the middle. We also have accumulated a number of royalties, so we set up a royalty holding company. And then at the very right, in green, you see all of the Mercury businesses that we're now expanding into, both domestically and internationally. We have a very clean capital structure, 33 million shares outstanding, no secured debt, no convertible debt, you know, no options warrants. It's very clean. It was a 3-year effort for us to reposition the company, let's say realign the company with an extreme focus now on precious metals. Zach? The strategy and that focus is designed to deliver $500 million in value over the next 3 years. That number is shocking to a lot of people, but our company has tied our compensation totally to the delivery of that value in a 3-year period. What I show you guys here is that when we break down the 3 or 4 things that we own, we're working on right now, from the Dayton mine to the Lucerne, which we sold to Tonogold, to the Mercury projects that we're launching, we show a value of over $135 million. That alone is over $4 a share. We're trading at $1.15 today. So my goal and Zach's goal in the next 12 months is to convince people about the value that's not being recognized today, but more importantly, to build on that value over the next 3 years to get to a $500 million valuation. I know a lot of people would be happy with the 4X. We're certainly not. At the bottom, you see the assets that we're monetizing that not only brings in $25 million, but Zach, if you can go to the next slide, it pays off all of our obligations and puts about $20 million into treasury. So we have a tight share structure. We're highly liquid. We're traded on the New York Stock Exchange, you know, and we're well controlled. So 3 tough years. I had no fun. 2017, 2018, 2019. Got a little bit fun at the end of 19. It's been, except for COVID, you know, wonderful here in 20. Not because gold is up, but because our plans are finally getting traction. Next slide. So this is what Tonogold acquired from us. In orange, you see all the Lucerne mine claims. It's an exceptional congregation of some famous claims, including the historic Woodville Bonanza, which was one of the most southerly bonanzas on the Comstock lode. You know, the blue circle delineates where that mine is, and then you can see just to the east of it, another structure claims the Pride of the West, and really they represent the most southerly Occidental lodes that Tono captured, and then we've leased to them the entirety of that red line, you know, going up to the north. To the left, you see the much fatter, the much more robust Comstock lode, and I'm going to leave it to Marc to tell you the grades and the targets that they've got there. It's almost unbelievable. Continue, Zach. That's the part there. This is what Tono announced a few days ago, and that's where they're targeting their drilling. You know, I'm going to leave this to Marc, but I just want to highlight that that picture of that drill in that bottom corner mobilized 2 or 3 days ago, and it is turning core as we speak. So it's extremely exciting for us to see drill rigs turning on the Comstock lode again, and Tono, the owner, the leader, you know, the driver of some exceptional geological assessment. Zach? Our southern part of the district is called the Dayton. We call it now the Dayton Complex because it represents almost 3 miles of the Dayton resource. We have almost 500,000 gold equivalent ounces in our last technical report, but we are about to publish a new technical report. We might be the first U.S. company that's U.S. listed to issue a report under the new U.S. SEC guidelines. So most people are familiar with the 43101, National Instrument 43101, which is the Canadian standard. We're going to be publishing our next technical report under SK 1300, which is a U.S. standard. I think we'll be the first company with resources disclosed in their 10K. And so we think that the market change in the gold markets, I think it's going to result in a lot more companies listing in the U.S. versus Canada. We've always loved the U.S. regardless in terms of the capital markets. But we did a ton of geophysics 8 years ago with handheld magnetometers and surface magnetic resonance. And that data allowed us to make numerous discoveries of high grade. Zach, if you can continue to the next slide. We did a ton of structural analysis, and as we continued to drill on the structures that we interpreted from those geophysics, we continued to hit high grade. So I mentioned there's about 500,000 gold equivalent ounces, about 300,000 ounces of gold, about 6 million ounces of silver, in the resource, but it's only the very, very top portion of this 3-mile trend where you see the little blue outline at the top. That's where our resource sits. The geophysics shows the extension possibilities. Next slide, please. So Zach, we just commissioned a full-scale 3-dimensional geophysical survey. You see the area outline that we'll be surveying to the south. What's remarkable about this is that all of our drilling, on average, was about 500 to 600 feet previously. I think Tonogold is going to drill the deepest hole in the history of the Comstock, in about a month. But the miners mine to depths of 3,000 feet, and there's incredible grades, 1,000, 2,000, and below. Well, this geophysical survey, which is relatively new technology, will give us 3-dimensional geophysical magnetics to depths of 2,000 feet. So when you think that, the north has outcroppings and visible mineralization, the south is a valley with 30 to 40 feet of pediment covering it, our ability to penetrate with 3D geophysics is going to light this thing up and tell us where to go. We know where the mineral trends are. We've surface mapped it. We've drilled it. But now it'll be like looking through a dirty window with a sharp magnifying glass. So we're very, very excited about this. And we're going to start doing this next week with the results expected as early as mid-October. Zach, if you could continue. We had already built economic shells for this Dayton resource. The yellow picture shows the internal economic shell that we built based on an $800 gold cutoff. And then we brought in SRK, who looked at the extensions and looked at some of the discoveries we had south based on those geophysics, and they extrapolated a bigger mine. Using the smaller mine, using the $800 cutoff, I put a $1,600 and $2,000 gold price on this thing, and we see $75 to $100 million of cash flow. So we got a real small mine with a real lot of value that nobody knows about. What's exciting is we believe we can triple this thing, and the geophysics will show us how to most efficiently do that. Zach, if you can continue. I want to just close off by saying, in entitling the district and in permitting it and transforming it to be ready to mine, and we love that Tonogold is doing what Tonogold is doing to mine, we won numerous environmental awards. One of the reasons for that is it's a historic district that left behind some mercury. That's very common in Nevada and in historic districts. We built mercury remediation protocols. We got approvals from the EPA for long-term sampling analysis and reclamation plans. And then a road next to one of our mines failed because it was built on old mine dumps. And if you could continue forward, Zach, we decided that with all the protocols that we luckily had, we were able to rip out the entire road. Continue forward, Zach. We were able to remove 300,000 tons of contaminated material. We sealed an old mine shaft, and then the federal government recognized us. Now you're seeing the new road. It cost us $3 million to build the road. It cost us $6 million to rip it out and rip out all the old mine dumps, and we got $9 million of gold and silver out of it, which shocked me. So that attracted a new technology to the district, which is very, very advanced mercury remediation systems. These are essentially placer mining and alluvial mining systems that are supercharged with mercury reactors, mercury centrifuges, the most state-of-the-art spirals and separators that we believe we know, but we're going to now prove to everybody else, will not only remediate all the mercury out of the soils, but will also extract all the gold out of the mercury. The mercury amalgam is what was left over by the old-timers. It was inefficient. And I'm proud to say that we just got a huge contract in the Philippines, and what you're looking at now is the Philippine system with the centrifuges and the mercury reactor heading over. It's due to arrive in October, and Zach, last slide, if you will, just go to the Philippines. Go to the next one, Zach, the final one. Basically, when we look at our business plan, we're launching the Dayton resource development leading to a new technical report. Tono is launching a massive exploration program in the highest grade areas of the Comstock lode. And we're launching mercury systems globally, which is a market beyond definition between historic mines and artisanal miners all over the world to clean up mercury and mine gold in an environmentally friendly way. So that's it, Henry. That's our update. It's very different from the last time we spoke, and we're very excited about it all.
Okay, we're going to give me a moment, and then we're going to bring up Eddie Sugar to ask some questions, and then we'll have some audience questions. I just received, this is a difficult day, but I just received a note from Appreciated Media, and unfortunately Steve Brown just had a family emergency with his father and will not be able to present after the gold company. This will give us an extra half hour. He recommends going to his website to see it, and we're going to bring him up on another webinar. But that will give us more time for Q&A. So that part is good. Unfortunately, these emergencies happen, and 9/11 is not a perfect date. So now I'm just going to bring Eddie Sugar up. Eddie, can you also put, there we are. Eddie, can you try unmuting yourself now? I don't believe this.
Oh, here we go.
Success? Yes.
Success. After that noise.
Yeah, that was...
Corrado, how you doing? No, we can't hear him.
Can you unmute, Corrado, can you unmute yourself, please?
Okay, now. How you doing, Corrado?
Good to hear your voice, man. Very good. Thank you.
Now, congratulations on a great year. Obviously, I'm being more involved on the Tonogold side. We're very happy with the deal that we did with you. But the first question, I mean, in looking at what you have, if you look at the company, you're basically outlining three different plays in a way. One is through Tono, one is through yourselves, and then one is a reaction to something that you have to do from the environmental side, which is creating a whole new business.
Exactly.
That whole new business, I mean, is there get a sense of what that market size is for that Mercury side type of business in terms of what that is? I mean, we all get what you're doing on the gold side, but I think that's the one that seems to be unknown as to what the potential is for that.
Yeah, so great question. So I'll give you context. You know, the UN 3 years ago passed the Minamata Convention, and 140 nations signed up to eradicate industrial mercury from industrial mining, and with an emphasis on ASM, which stands for artisanal and small scale miners. And so 140 nations signed up, including the Philippines, including Colombia, including many other gold-rich districts, to eradicate the mercury from artisanal mining, and it's a global dilemma.
I'm just setting that up. Excuse me one moment so people can catch it. They can start emailing their things. Go ahead. Okay. Did we lose it? Uh-oh. I just lost I try it again. Sorry. Please unmute. Sorry, guys. I was trying to set that up earlier.
That's all
Go
right.
ahead, Corrado.
Can you hear me now?
Yep.
Yeah, so in Nevada alone, we've identified over 1,700 abandoned mines, of which a majority have mercury. And I think Nevada ultimately will tail to California, where we're getting a lot of inquiries as well, the mother lode areas and the old historic mines. So, I mean, I don't want to exaggerate it, but the market feels unlimited to us right now. Certainly, project selection will be one of our critical successes. Secondly, we've modeled financially, the U.S. system, which is up and running now, and the Philippine system, which hasn't arrived there yet. But by the end of the year, once we have a couple of months of operating experience, we'll start to provide guidance, both in terms of revenue cost and profitability. But the thing I'd like to leave you with, obviously we all love precious metal mining. It's a passion, besides the business. But what I love most about the Mercury business is one system costs about $1.5 million to $2 million to deploy, and has the potential, and frankly, I ran this at $1,300 gold, to generate almost $1 million a month. So when you start to think about, and that depends on grade, that's like a 1.5 gram scenario. You're going into high grade, formerly high grade districts that are contaminated and cleaning up this metal. So the potential is to have, dozens and dozens of systems all over the world, with incredible cash. And the cash, or the gold, if you will, starts coming out within a day of putting it in the hopper. So it's low capital, fast cash return, which, as we know, is a little different than hard rock mining. So we like both. We like the potential for both, but we like the fast cash of the Mercury systems.
In terms of the joint venture with, not joint venture, but the partnership with Tonogold,
yeah.
Do you see that being a long-term?
I do for two reasons. One, they're an exceptional group of people, and I have to say, and I know this is going to come out wrong, but I mean it the right way. I mean, the relationship has grown so remarkably over the last 2 years. I mean, it started with me and Marc, and it was almost like a bow tie relationship. Me and Marc touching, and then but now it's like, from geologists to metallurgists to corporates to boards, it's expanded. So we're touching on so many fronts, including you, and the reliability, the trustworthiness, the alignment, maybe that's the right word, is so very strong. I mean, the relationship could just be, we might just have a royalty relationship, in which case we're super aligned for their success, or it could expand beyond that. But the alignment is so strong in terms of doing it right and doing it well in the district. So, certainly on the Comstock for a long time, but hopefully beyond.
Okay. And in terms of, I mean, do you see that you're going to utilize the knowledge in the area to grow to other assets in the area, or you have enough on your plate between the different groups that you're working with right now? Yeah, so that's a great question. So we learned some tough lessons on the mining side. In fairness to us, Lucerne, had a very narrow and small permit, and it was hard. And, we disappointed our investors in 2015-16 when we had to stop mining in Lucerne. Those permits have been expanded massively, so the footprint that Tono has to operate in is much bigger, and I think they'll do fantastically with it. But we did learn fundamentals, economic lessons on geology, feasibility, etc. So we have a keener eye, I would say. If there's real opportunities, to grow precious metal-based assets outside the district, we'll look at it. Right now, that's focused on Mercury, but
but we're kind of Nevada homegrown. So we love Nevada, we love Nevada mining, and that would probably be, outside of Mercury, that would probably be our first preference if we were going to do anything. But Mercury's got our hands pretty full right now, but we're keen to look at growing.
Okay. Henry, I'm going to hand it over back to you.
Because I was just going to say we're being run out of time. What I would like to do, since we do have a little extra time, is if some people like to just put any of their questions in chat, I will try it the other way. We already have one question. We'll do about 3 to 5 minutes, and then we'll switch over to Tonogold. The question is, how does COVID-19 affect your day-to-day operations?
So day-to-day, we're fine. We have 12 core people, including geology, engineering, metallurgy here on site. We're separate and we're working every day. We can work remotely. Where it did trip us up a little bit, Henry, was the Mercury equipment. It took us 2 months longer to finalize it because some of the welders and contractors were not available to us. And then it took us an extra 2 months just to get the shipments to the Philippines out the door because of COVID. And now we're waiting to make sure, because we can't go over there and install these systems and then be quarantined for a month, right? So we're waiting for the Philippines to clear us, and we're going to the highest levels of the government, to get clearance so that we're not stuck in a hotel for 2 weeks, in Manila, and then go down to Davao and be stuck for another 2 weeks. So, but having said that, the government, that maybe answers another question. The government embrace us because we're coming in for environmental cleanup, so the historic jurisdictional risk is sort of flipped on its head when it comes to mercury remediation. I would be a little bit nervous mining in the Philippines, but cleaning up mercury, we're embraced from the president to the governor down to the mayor. So.
Yeah, that's definitely a good thing. All right, well, we appreciate that. And again, anyone interested to certainly register on your website to get communications. And we're going to now present, we're going to change presenters and bring Marc up for Tonogold, which is a related situation. So obviously when one does well, this will reflect very well on the situation here as well. So give me a moment, and Marc will be... Okay, we're going to make you presenter. There we go. Looks familiar. I just want to bring yourself up, though. We see the screen, but I don't see you or hear you. So we get to see
muted. Oh, there we go.
There we are. Everybody's in trouble with muting. By the way, I just found out from one of our people, depending on what version computer you have, you may have, when you first logged on, had video and audio, and you had to click both of them. It's not on my systems, it's not on my associate system, but apparently some of the computer systems require that you click the video and the audio.
Gotcha.
As we just found out, that's probably what happened to us the other day.
Yeah, exactly. So can you see the screen okay?
I see the screen, I don't see you, but because the screen is nice and probably more important.
Yeah, I think it's probably better for everyone not to. I'll come in on the Q&A.
Okay. Okay. Feel free, and you may want to just turn it. There we go. That's fine.
Okay, so let me just give you a bit of background. Nevada, which is where the Comstock lode is located, as Corrado mentioned, it's a major global gold producer. It's actually, if it was a country in its own right, it would be the 5th largest producer in the world, behind China, Russia, Australia, America, and Canada. And therefore, it's a very supportive, friendly environment, and all the majors are there and have substantial interests. So I don't think we could be in a better location. Comstock lode, it has a 5, and that's the on the left-hand side. It's that red outline, which is the trace of gold veins from the surface. It's 5 kilometers long. We have 3 kilometers. It's known to be developed down to 1 kilometer. Dips at 45 degrees to the east, and is approximately 50 meters in true width. If you multiply all that out, you end up with about 500 million tons within the mineralized zone, Now, I'm not suggesting all of it is, you know, grade or economic, but I just wanted to put that out in terms of order of magnitude. We're looking here at 500 million tonnes, you know, that is known about. So, as Carter mentioned, the Comstock lode was actually the richest precious metals discovery ever made in America. It was discovered in 1859, and I think it still holds that record. It was a catalyst that developed San Francisco. It helped fund the Civil War during the 1860s, and because of that, Lincoln declared Nevada a state during the Civil War. And more importantly for us, he sent in a team of experts to monitor what was going on. You know, geologists, mining engineers, cartologists. Now that's unheard of in the 19th century gold rushes. And of course, you know, you've got these guys with their pickaxes, they've got their share of the claim, they're going underground, working 12, 14 hours a day, coming out, having dinner, going back down the hole. The last thing they were thinking of is recording what was going on. So this is pretty unique, I think, for 19th century mining, and it's given us a lot of information. I hear a lot of the time that the Comstock mine, because of how much it produced, it's all gone. The old timers knew what they're doing, they wouldn't have left anything behind, they're better, they're cleverer than us, and all of that's true. But back then, they needed 50 grams of gold equivalent, 50 of gold equivalent in a rock in order to merely break even. Today, that number is 5 grams. So I'm not necessarily looking for what the old timers missed. I'm looking at what they knew was there, but they left it in the ground because to them it was waste. Now that 50 to 5 is quite important, and it's not unique to the Comstock. It's basically around the world, and a lot of the significant gold producers today are actually producing from the 19th century time period, like Kalgoorlie, the Super Pit, and Ballarat, California. Comstock's one of the few that hasn't incurred modern day production. So basically the gold price was fixed at $20. It had been fixed for 150 years. It was going to be fixed for another 100 years until Nixon obviously abolished the gold standard in the 1970s. Their costs were around $21 a tonne, which meant that they needed just over an ounce of gold recovered to break even. An ounce is 31 grams, so that's 32 is what they needed. Their metallurgical recovery is 65%, that's what they were able to get, so gross that up, that's what they needed, 50. So today, the gold price is over 3 times higher in real terms than it was back in the 1800s. If you applied CPI to 20, you get to 600. And as I say, today the price is what, 1900, so it's 3 times higher. Costs are down about 70%, and that's because they didn't have they didn't have trucks, loaders, drill rigs, etc. Everything was by hand, so productivity was low, and therefore unit costs were high. And then metallurgical recoveries, of course, again technological. Today, of course, with trucks, loaders, etc., the costs are down significantly and metallurgical recovery is up. So there's the opportunity. So really we're saying, well, how much did the old timers leave behind that's higher than 5, but less than 50? I'm not saying we won't find a 50, but that's not our strategy. This is what they call a long section. This was actually produced by the government in 1883. And it records everything that had gone on our 3 kilometre strike. This line here is the surface, so we're looking like into the ground. We're looking actually west, north is to the right. These patches, these shaded areas are the bonanzas. They're the 50 grammers. And of course, the old timers, they found, surface material and then they followed it down. But how did they find these zones down here? They didn't have drilling, as I say. Today you would put drill holes down and you would delineate a resource before, before sinking shafts, etc. They had to sink shafts, and they developed these drifts, these tunnels, basically 2.5 meters high, 2 meters wide, in order, and all they were to do was to find a 50 gram. If they didn't find one, they'd go down 30 meters, 100 feet, and do the same again until they snuck one. Now, the fact that, okay, so in summary, 4 million tonnes was mined from these stopes at an average grade of 94 grams, 3 ounces for 8 million ounces of gold equivalent. The drifts actually contributed 2 million at 32 for another 1.5 million. Now you ask, 32 grams, that didn't make the 50, cut-off that I was talking about. These drifts were a sunk cost. Therefore, anything above 24 grams, 24 was their marginal cut-off. Anything over 24 would have covered the cost of processing and the metallurgical losses, and would have put money back into the miner's pocket as a contribution to the cost of having developed that drift. And that is probably the most important number in our assessment of what we think the old timers left behind. As I say, this ore body or this structure is 15 meters wide, so this one line hides the fact that you've got development behind it, on the hanging wall, footwall, and in between. Now, when I look at this, when I first looked at this, you see these bonanzas stopped here. And I'm thinking, well, there's some geological structure, it's heading south, there's some geological structure that's, that's cutting this off. But what actually happened is, can you hear me?
Yes, I hear you.
Okay.
Very interesting presentation so far.
Back in the day, a guy called Adolf Sutro, he was an engineer, not a mining engineer, but a civil engineer. He decided he wanted to cash in on the riches of the Comstock, and he developed this dewatering tunnel. Like most of the mines in Nevada, it's very wet. And in mining, you've got either too much water or too little. Here, it was too much. He developed this tunnel, and it comes out of the page here, about here, towards us 4 miles downhill using gravity, and it drains into the Carson River. And it still drains today, although it just dribbles. And therefore, up here is dry. Down here is very, very wet. So there's been about 20 books written about the Comstock. The last one written was published in 2018 by Greg Crouch, called The Bonanza King. And we actually rang him, and he's now a consultant to us, and he's been able to dig out archival records that we didn't know existed. And those archival records are showing they did find high-grade mineralization down here, but they literally were just fighting to keep their heads above water, excuse the pun, but that was absolutely true. And in 1882, the Exchequer hit a major water source that flooded this whole area. Everyone thought that the owner of this shaft, a guy called John Maggie, who is the Bonanza King, was going to drain it off for everyone else. He tried to do a cost-sharing arrangement. They wouldn't have it. He was the richest man in the world by then, an Irishman that was born in poverty, and he became the richest man because of the Comstock lode. His wife had moved to Paris, had bought a house on the Champs-Élysées, and he just said, no, bugger it. If you guys can't, aren't going to play ball, I'm turning my pump off, and I'm leaving. And that's what he did. No one's been back down here since 1882. So what Greg Crouch, the author of Bonanza King, he's been able to dig out records. These covert-looking signs are actual records of, or reports, verbatim reports on the material that is potentially down there. But as I say, our concept is really what they left, they didn't know was there. This is a plan view, so you're looking down on the ore. North is to the right, west is going up. The detail that this is 1883 as well. So just taking that square, this is the detail that we have. It's very, very detailed. It talks about where the mineralization is. These lines here are the drifts, and it tells you what level they're on. Our geological consultants have been able to digitize this and put it into a 3D model, which we find very useful. But what came out of this was that there was 200 kilometers of these drifts, these exploration drives that were developed. And if you multiply out, you know, the height, the width, and specific gravity, that comes out to 2.5 million tons was, you know, mined as part of those exploration drifts. Now, for me, the aha moment was, well, 2.3 million tons, in other words, 92% of all of these exploration drifts made the 24-gram cut and actually graded 32. That's really quite significant. And as I said, when they developed these drifts, they didn't find a 50. They'd go down 30 meters. 30 meters, 100 foot. Do the same again and again and again. And as I say, they developed these 3 on each level. What they left behind between these drifts is a factor of 26 times what they actually mined. So if they mine 2.3, potentially there is 60 million tons just between those drifts on those narrow veins. That doesn't include anything that could be between these. And again, indications from reports are that there is good mineralisation in here that is of grade today. So if you use the same grade that they, the average grade that they achieved, that's, again, order of magnitude 40 million ounces just between these drifts. 40 million ounces, there's like 3 deposits in the world that have that size. Again, I'm not suggesting that we need to drill it. Now, this is the 3 kilometres we talk about. This is the limit of the drilling, which again was an aha moment for me. For something as significant as Comstock, having this, virtually zero drilling is unbelievable. These deeper holes, when we actually put them into a 3D model, it became obvious that they were drilled 30 metres short of where the known mineralisation is. So they're irrelevant. Of some of these holes that were drilled shallow, these holes I'd actually be, really happy with. 6 metres at 23 and 11 metres at 33. So we're starting a drill program. First one, basically modern history on the Comstock lode. It started last week, $7 million. The contractor is actually taking 50% of his cost in shares at 30 cents. It's going to take 9 months to a year and 26,000 meters. This is the program. These dots here are the holes that we are drilling. So most of it above the Sutro tunnel, which is dry, some below it, and again following some of these areas of significance. So look, the question I get all the time is, look, I've been in mining for 35 years. I've looked at hundreds, if not thousands, of projects, and you get the odd one that looks too good to be true, and they always are. Always are not true. And I've had to really beat myself up about this one. And look, for a gold project, the fact that the gold price has was fixed and it's gone up 3 times is the key to the opportunities. And as I say, most of these 19th century gold rush mines have converted into major mines today. The Super Pit is producing just under 1 million ounces a year in Kalgoorlie, and again, it's basically from the old timers' waste. A silver mine is quite the opposite. The silver price is actually half in real terms today. So what is Comstock? Comstock is actually, there's 20 times more silver than gold. And back in the 1800s, only 38% of the revenue came from gold. The rest, 62%, was silver. But now, today, that same ore, because of the price relationship between gold and silver, you're looking at 78%, the opposite. 78% of the revenue is going to be gold. So people think of Comstock as a silver mine, and I think that's been one of the reasons it's been overlooked. But it's actually, it's transformed over time from a silver mine into a gold mine. And as I say, I think that got missed. I think that Comstock were the first to realise it, and did a fantastic job at consolidating the ownership of the ground. So we're focusing on it's taken us 6 years to finalise this transaction with Corrado. We've kept a low profile. We're an OTC pink sheets, and that's helped keep the low profile. But now we've got ownership. Now we've got the ground. We're taking that veil of secrecy away. We're going through a process of becoming fully reported and upgrading the listing to the New York later this year. We're strengthening the board and looking at a further equity raise early in the new year to fund the next program. But this first drill program is more a proof of concept. And I think that it won't produce a resource, but I'm hoping that people that think they know Comstock and have these misperceptions that it's a silver mine, that it's been mined out, it's gonna change the attitudes of investors and the community very, very quickly. And as I say, the other thing that is worth noting is that the major gold producers, their reserves have reduced constantly over the last 10 years. They haven't been able to replenish their production with discoveries. They are getting to a point where they have to acquire projects. And something like this, depending on obviously whether it ends up being a 10, 20, 30, 60, whatever million ounce deposit, it is going to be one that I think is going to be highly sought after. And I don't think we need to necessarily wait for the full benefits to get into production. I think they'll happen somewhat sooner. We have 400 or 287 million shares on issue. We've issued convertible notes on a fully diluted basis. We've got 500 million, 550, 26 million will come in through warrants. I reckon by the time we've drilled this out, the share price will obviously increase, and we'll end up with about 600 million shares. So it depends on how many ounces we end up. That's going to be the share price, obviously. Management have over 30%, as shown here. Ken Mullis is the billionaire merchant banker. He was the one that actually put me in touch with this opportunity. He just bought 5 million shares back in 2012. I was here on holiday from Australia, and because of this, I never went back. I've become an American citizen, and we go from there. So the background of the directors: we've strengthened the board recently with the appointment of Alan Edwards, a mining engineer of 40 years, and Dr. Vers, a geologist of 40 years, specialising in epithermal deposit. As I mentioned, I've had 35 years in the mining industry on a corporate level. I've actually worked underground mines, open pit mines. I'm a finance guy by background, but the knowledge, the drivers, I can actually look at opportunities and dismiss them or follow them up pretty quickly. I was one of the founders of a company called Lion Ore, which is a Toronto listed company, and we turned that from a shell basically similar to Tono into a $6 billion enterprise. We got taken out by Norilsk for just over $6 billion cash at $27 a share. We started at 20 cents, so that was there was no share consolidations along the way. It was basically real growth. And then we have a number of others. Jordan Mullis is Ken's son, and it's our intention to further strengthen the board. We've been drilling for a week, and we will be drilling for the next 9 months. The first results should come out in 3 to 4 weeks in terms of assays, really that's that's what I can tell you in the time that I've got available. I've got a link here to this presentation on this back sheet, as well as my my contact.
Excellent, Mark. Could you also put on your video so people can see you when Edward asks his questions?
Absolutely.
So let me just. Oh. You have to. There you are, Edward. You're back on the thing.
Hey, Mark, how you doing?
Good, Eddie. Can you see me now?
No.
Yes.
Yes, we can. There we go.
So, Mark, obviously a great feat to have gotten and worked with Corrado to get this asset, and then now start developing this asset. In terms of, I also want to just point out, I mean, obviously we didn't talk about it much. Corrado pointed to it in his presentation a little bit, but there is another asset that basically underwrites the valuation on the company, being Lucerne, which is a mine ready to be put in production. The decision made by the board at Tono was that for the money that we're raising at the moment, or have raised at the moment, that and you believe that the drill bit that we're putting down to prove out what's in the Comstock lode is far more advantageous at the moment than proceeding at the moment with Lucerne, though Lucerne will be looked at some time during 2021. Is that correct?
Yeah, absolutely. Lucerne was the project that Corrado was talking about, and it needed an upgrade in terms of the critical mass, and I think that once you can get to that, you can generate a good cash flow. It's not a huge project, maybe 4 or 5 years, generating $50–60 million of cash flow a year, but that was at $1,200. It will be a lot more now. So you're looking at $200, $300, $400 million value, but as I say, every dollar that we spend on that is a dollar we can't spend on the exploration. I think that the leverage is significantly higher on the Gold Hill, and let's just focus on that first of all, and we'll re-look at Lucerne down the road.
And in terms of, I mean, without getting too excited, I mean, until the drill bit goes down, obviously what's happening now, the potential for this to become another major mine in the U.S., how does that fit in terms of when you look at the U.S. and prospective mines coming on stream? From the understanding that I have from what in my discussions with you and the board, this could be in the top 5 or 10 mines if what you believe is there turns out to be true in the U.S. Is that correct?
That's correct, and it's not just based on a finger cross strategy. It is, again, you look at Kalgoorlie, for example, and other 19th century producers. Kalgoorlie was the gold mile. It produced something like 12 million ounces of gold. Then, of course, it stopped in the early 1900s, or curtailed, as every other mine, because the gold price was fixed, inflation went up, the costs were high because you were getting deeper, so everything stopped, and there was this hiatus until 1980s, when the gold price started to pick up after Nixon abolished the gold standard. But look, I think that this has been missed. The Golden Mile, as I say, the Gold Mile turned into the super pit. The super pit's producing just under 1 million ounces of gold a year now, and has been for 30 years. It's got another 10 years to go. So most of these mines that are mining what the old timers left behind, because to them it was waste, the current production, modern day production, is substantially higher than what they produced back then. I'm not relying on that as the theory, but the information, the data that we have, the records that Greg Crouch has been able to uncover include, for example, monthly reports by the mine superintendents, and he's been going through them, and these are handwritten. They're very hard to read, but he researched this project for 4 years when he wrote The Bonanza King, And, you know, we gave him a few key words like, the artificial intelligence and porphyry, quartz, whatever. And he kept coming back to MDA and saying, look, this is a reference here. Is this significant? They'll say, they'll read it in the context, yes or no. And we're building this further story around the numbers, around the data, that does confirm that there's, you know, out of that 500 million ton potential, we think there's going to be a fair amount, a lot of it, but we don't, you know, that is going to be economic. Now, don't forget, they mined 8 million ounces of gold and 200 million ounces of silver. In today's thinking, that's a huge project and a huge amount of tons, but that came from just 6 million tons, and it's because of the grade. It's, you know, 1.5% of what I think is the potential within that mineralized structure has been mined. That's it. So I think this could be, yeah. I don't want to, you know, it's one step at a time. This is an important, you know, proof of concept. We're not going to rush. We're not going to fight. We're going to do the things the way we, you know, we do it because we own a lot of the shares, and we'll do it because of, you know, the shareholders. Myself and Travis Miller, who's the other exec director, has, you know, probably 20-30% of the company, 20% of the company at the moment. So, yeah, we do it for fundamental reasons, not for market reasons.
In terms of looking at this, what are in your mind, the biggest data points that we should be looking for from the drill program then over the next 6 to 9 months of information that will be flowing from the drill results that are going to be coming out?
Yeah, look, you know, it's going to be, as I say, a proof of concept more than anything. You know, being able to reference a report of production and widths and grades that, you know, have been reported with modern day exploration. And, you know, our plan is to cover something like 1 million square meters. Again, it's not going to be infill drilled to a resource, but you know, we want to get that proof of concept to say that you know, the data, the information, the records that we've got are pretty accurate, and I think one can determine themselves what the potential would be, and then it's a matter of the next year, you know, drilling it out to a resource.
Right. Okay. We got some interference somewhere, but I'm not sure where.
Yeah, somebody's, I hope that's not me, but I don't think it is.
Yeah. And I'm going to send it back to you anyway and let the other...
Okay. Good. We're going to take for a few minutes of questions. If people have it, there are 2 ways to do this. You can simply raise your hand. Actually, 1 second. For those who, by the way, you can simply raise your hand, or I'm going to try the Q&A, which I haven't done before, or just simply go in the chat. That's certainly a very interesting story, and if this were a live presentation, which we hope to have them in sometime when it's possible to travel between New York and Nevada, then we'll certainly want to give copies of the book as well. I think that'd be interesting to give one of the books to the attendees. So we certainly would love to have you, Mike, maybe in our February conference in New York.
Absolutely.
By then, this should be substantially a higher story, and we can say we've already heard it. Okay, so we're going to see if anyone has any questions. You can do it in the chat, or if you press reactions at the bottom, you'll see there's a sign that says with your hand, or you can just put it in chat if you like. Again, unfortunately, the next presentation, which is Appreciated Media, there was an emergency with his father. We're going to have to put that into a future situation. That's in the entertainment, so we're staying with gold. For those of you who haven't heard my view, we're very bullish on gold in the fall. this month. We can go either way. We can break the 1900 or the 2000. But once we get to closer to the election into the end of the year, it's going to be a very, very hot commodity. And certainly it's going to be something you want to have some gold exposure for or to add to your gold exposure. So if we have any questions that people want to ask, or you can simply go to the website, I'll give it a chance. We have a relatively quiet audience today, which is fine. So far I don't see anything in the chat. Let's just see if the Q&A thing works in a moment, and then we'll go from there. Attendees. Just going to try this. Give me a moment. So if anyone wants to get into the queue, so far nobody's in the Q&A, which is all right. I think really what the issue is going to be how the results of the drilling are. It certainly looks very positive, and certainly once the first drilling goes, this is going to move on. Oh, I see one person. Let me just see that one chat who I've got there. Oh, can you please return to your slide with the links so they can see where to go? It's one question. Mark? Whoop, you got muted. Let me unmute you. Mark, could you please go back to the slide with links?
This one?
Well, put it up. I guess you mean the links to, I assume you mean the website, Tom. So, no, those, I don't think that. Ah, that's the one he wants to see. No, that, but you just had it.
Oh, that one, right.
Yeah, it's a good idea to leave that on during the time.
Yeah. Yeah.
Both, actually, the other one's good too. Yeah, so you can write that down. Certainly it's worth looking at, Tom. See if there are any other questions? Okay, I guess that's the important thing. It's obviously something worth watching, whether you want to put a little gamble in it now or whether you want to wait for the first drilling results. It's certainly an impressive story that you want to track and at least get yourself on the